5 seconds to the open.
Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to Follow the Money Radio, found right here every single week on followthemoney.com. Plus, on top of that, we have a huge archive of previous shows that you can check out. Just simply go to followthemoney.com, and then when you get there, you'll see in the menu podcasts. And we have, several different podcasts we've done over the years, and you can find all of those, a big archive. I encourage you to go check that out if you like to learn more about the economy and about investing and about geopolitics even. We've done so many different topics, interviewed so many incredible people over the years, and it's all right there in that archive. Well, today we are going to take a break from the series that we've been doing. We've been doing this Charting the Course series, a very, I think, important series. We've got some great feedback from many of you, and I really appreciate the emails we receive from you. The series we have been doing, Charting the Course, we've already gone through the C, the acronym C for commitment. We've went through O, which is overhead. We've talked about U, which stands for unlearn. And then last week we covered the R, which stands for reserve, building a liquid savings reserve for you and your family, so unbelievably important. And today we're going to take a break. We're going to come back and cover the last two letters, S and E. In the coming weeks, we're going to cover S, which is streams, income streams. To think about income instead of just a W-2 paycheck, instead to think about how can I create multiple streams of income. We'll be talking about that. And then also E, which stands for education. The right kind of education is what you need to succeed. So we'll be talking about all of that on some future podcasts. But today we decided to take a break and focus on gold. We've entitled today's broadcast, Gold Investing in 2018. It's a theme that we hit on quite frequently here at Follow the Money because, quite frankly, the global economy is just immersed in a massive amount of debt. There was a recent statistic put out, I believe it was by the IMF, that indicated that all of the world's debt now stands at a total of $247 trillion. What's interesting, though? That, of course, that number is astounding, and we can sit there and think about that, and it just blows our minds thinking $247 trillion. We're just getting used to millions, let alone billions, and then trillions. But what's even more weird about all of that is that how much money is actually in existence. If you look at the CIA data on how much money is in existence, you're talking about a total of about $80 trillion. So we literally, if we wanted to pay off all of the debt that is in existence, we couldn't be able to do it because there's only $80 trillion worth of money, and there's $247 trillion worth of debt. So we are truly in a major, unprecedented era of economic proportions that is just mind-blowing. I mean, really, really is. There is nothing we can point back to in history to say our time was like this. Now, we certainly have seen debt in the past. We've certainly seen over leverage in the past, but we have never had the level of debt that we now have. And we have never had the obligations, the unfunded obligations that we now have. Friends, today, there's just no plan in Washington, let alone in other countries, to solve the massive global debt situation that we find ourselves in. So before we move into the crux of our podcast today, because I've invited on our precious metals advisor, Tom Cloud, to kind of give us an update on what's happening in the precious metals world, because precious metals serve as the stalwart against this global debt situation. Precious metals for a long time have been viewed as money. And let's just go through 5 reasons why I own physical gold today. You know, I've owned physical gold for many years, and I've talked about these 5 reasons in the past, but I think in the middle of the sweltering heat of 2018, as we see the debt levels rising, and as we see gold prices and silver prices really stagnant, if not falling, it really probably serves us well to stop and think about why gold and silver really might be a smart idea in this current environment of complacency. Let's talk about 5 reasons why I own physical gold today for the long term. Number 1 is that gold is money. You know, for millennia, humans have considered gold as the ultimate store of value. They've considered it the ultimate medium of exchange. And, you know, no amount of paper money can change that fact. In recent years, however, mankind has foolishly believed that paper currency issued by government fiat or decree somehow has the ability to replace these other historical forms of money. And this is a grave mistake, and it'll ultimately drive the global economy back to a sound monetary system such as gold. It may begin one nation at a time. We might see one nation begin to move back to the gold standard and then maybe another. Not exactly sure what that will look like, but what I do know is that gold has essentially kept its value over decades and over centuries of time. You know, for example, 1 ounce of gold was worth about the cost of a very nice suit in the early 1900s. Nice man's suit you could buy with 1 ounce of gold. Same holds true today. You know, compare this to the United States dollar, however, which has lost 95% of its purchasing power since the early 1900s. There's just no comparison at all. So, number 1, gold is money. Number 2, gold has intrinsic value. You know, this is because gold exists in finite supplies. Its value cannot be derived by simple government edict or decree. Governments try to manipulate the price of gold, but modern paper currency has no intrinsic value. The only difference between a $100 bill and a worthless piece of paper is that the government says that the $100 bill has value. But this value is not intrinsic. It means, you know, meaning that the $100 bill doesn't hold value in and of itself. I mean, it literally is just a piece of paper, whereas gold actually has intrinsic value. In and of itself, it actually has value. Number 3, I don't trust the U.S. federal government. I don't know about you, but I don't trust them. I don't trust the monetary wizards at the Federal Reserve to protect my family from a hiccup in the global fiat currency system, let alone a total economic disaster. So by owning and holding physical gold, I am able to insure myself against Washington's numerous inept policies. You know, paper money is a modern experiment, which is ultimately heading for a solid brick wall. There are already growing movements around the world, as I mentioned, to restore gold as money, or to allow gold to once again play an integral role in the national monetary policy. But no matter what the folks say in Washington, the U.S. economy faces tremendous hurdles as we move into the future. But just consider a few of them. We have a $21 trillion plus dollar debt that we have no plans to pay. We have no plan right now in 2018 to solve the entitlement crisis that is growing out of control. We have no plans to shore up Social Security. We have no plans to shore up Medicare. We have no plans to deal with the student loan debt crisis, which is spiraling out of control. We have mortgage debt near all-time highs, credit card debt near all-time highs. Government debt, of course, near all-time highs. Business debt, corporate debt. I mean, it doesn't matter where you look. There's all manner of issues facing America. And on top of that, as we talked about in our last podcast, most people aren't ready for any kind of economic disaster because they're one paycheck away from financial disaster. They don't have any money in savings. And so right now is a very precarious time, even though it feels good, even though the prices of things are rising, even though asset values are rising on a nominal basis. This is a time of great complacency. We see it in the savings rate that is really pulled back to the lows that we saw just prior to the 2008 crisis. So right now, gold is just looking even more attractive than normal. The fourth reason why I own gold is because gold is owned and hoarded by the richest people in the world, and it's publicly maligned in the mainstream press. Now, I think of gold sometimes a lot like I think about whole life insurance. You know, hardly any person of measurable wealth chooses to rent his life insurance by buying term life insurance. And yet term life insurance is pushed upon the masses as the best insurance to buy, always in every single case. In the mainstream press, the financial press, they all say the same thing. But you know, it is, if you look at corporations, however, when they structure their executive compensation for their key upper management employees, search long and hard to see which one of those executives is given term life insurance. That doesn't work, right? They give them permanent life insurance. No, these guys don't want to rent their insurance. They want to own their insurance. In other words, rich people demand permanent life insurance while telling the poor to buy term insurance. And it's no different with gold and the entire financial planning world for that matter. The wealthy elites, they own several things, right? They have wills, they have trusts, they have estate plans. They own their insurance. They don't rent it. They don't buy term and invest the difference. They own their insurance. You know what else they own? They own gold. They own gold along with a myriad of other tangible assets. At the same time, they tell America's working poor and the middle class to buy term and invest the difference. They tell them to put all their money into the stock market. They tell them to put their money into good growth mutual funds. And it's a scam. It's a scam because what happens is people don't have diversification. They end up with all these paper assets that are obviously not going to protect them in the event of a major breakdown in the overall economy. So with today's out-of-control levels of counterparty risk, I like that my gold that I hold is no one else's liability. There's no claim on the gold that I own. So no one can purchase a derivative on the physical gold in my possession, and that makes me feel good. The fifth reason and final reason why I own gold is for the purposes of diversification. You know, we just talked about last week on our last podcast about the need to not only diversify your investments and to diversify your income, which we'll be talking about on an upcoming podcast, but also to diversify your savings. And we talk about the DSL savings. You can go to followthemoney.com/DSL and read all about it. But it's our diversified 6-month liquid savings plan. And basically, I use gold and silver not only for my long-term investments, but also for a part of my short-term liquid savings reserve. I believe in being spread out in my savings due to the eroding factors on money, which includes inflationary pressures. So although gold and silver play an important role in my own personal financial holdings, I remain balanced, and I really don't hold more than 15 to 20% of my total assets at any one time in precious metals or anything for that matter. I think it's wise to keep yourself spread out. In addition to precious metals, I like real estate. I like stocks. I like investing in my own businesses or investing in other people's businesses as a way to diversify my overall investment portfolio. And so, there's plenty of reasons, as I've laid out here, to own gold. But right now, as we look at the price of gold and silver, we see that they're pulling back. We see that they're not playing the traditional safe haven role, despite some of the worries that we have seen in the overall economy over the last couple of years, especially. And so what I've done is I've invited on our good friend Tom Cloud, Precious Metals Advisor. On the other side of this break, I'm going to bring him on and we're going to talk about the state of precious metals in 2018. Stick around. We'll be right back. Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years' experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812. All right, well, to continue our discussion upon precious metals, gold and silver, palladium and platinum, we're going to be joined by my good friend Tom Cloud. As you well know, he has been a precious metals advisor for well over 40 years now, serving clients all around the world. Tom, it's great to have you on the line today. Thanks for joining us on Follow the Money Radio.
Well, Jerry, thanks for having me. It's always a pleasure to be on. I always enjoy talking with you and your commitment to your clients.
Well, I know that many people really enjoy hearing your updates, and you keep them very regularly updated on this podcast with a weekly update, and I know many people appreciate that. You know, gold and silver have not had a stellar year this year. They've been kind of treading water, both of them down for the year so far. And one of the questions that we see a lot is, where has the volatility in the gold market gone? You know, when we look back to the year 2017, for example, just last year, the price of gold remained stable and price volatility hit a 20-year low, despite a rather eventful year. I mean, if you look at all of the things that happened last year, of course, it was a pretty eventful year. According to the World Gold Council, there wasn't a single trading day during the year last year when gold ended more than 2.5% higher or 2.5% lower than it had ended the previous day. And the last time we saw that was way back in 1996. So the volatility, so not only are prices just somewhat depressed here, but there's also a lack of volatility. It doesn't seem like gold is playing into that safe haven asset that we often have seen it do in the past. What are we missing here? What's happening in the price of gold, and where's the volatility gone?
Well, we're not missing anything, because what is keeping the volatility is the lack of investors, the people that are buying gold. It's at my company as well as the world's central banks. You know, we've seen them every year now for like 7-8 years be net purchasers. So we're seeing a big tonnage move to central banks, and especially into China and Russia. What we're not seeing with the volatility is the investors that are buying and selling. We see a lot of them selling. The little guy, and I was talking to a client of mine last week, and I was saying to him, we've had the biggest orders this year in 42 years in business. We've had 3 of the 5 biggest orders we've ever had, and it's them that are keeping it, the volatility down, is because if the central banks weren't buying, Jerry, quite frankly, we would see some big drops in gold. Now, the other thing has been the news about gold-backed cryptocurrencies, and we've seen this, I can't pronounce it, but Versasium in South Africa now working. You can buy gold tokens. They've got the gold in a COMEX warehouse backing, and the SEC is looking at the offering right now where it could be sold in the U.S. And there are at least 3 other cryptos that are going to be backed by gold that I know that are in development. So it just is a matter of time to get all these things done. But meanwhile, the little guy is scared to death when there's hardly any risk at all. He's the most scared because of what you said, is we've had a 5 or 6% drop in gold this year. But you got to remember, too, we won't try to forget we were up like 2% last year. We're down 6% through June. But just remember, gold ended up 12.5% up for the year after we had the big September and October and into November run-up. So we're hearing this year could even be bigger, the run-up from the big wholesalers. And the other thing, Jerry, is the premiums that have been gone down so low are not low because some of these major wholesalers that we deal with, they call it the futures market when they could tell they couldn't stop it from going down when the big boys shorted it. So they shorted it, watched it go down $30, $40, cover their losses in their inventory where they had no losses, and put their premiums right back up. So there are behind-the-scenes workings right now that are going to be very beneficial to gold holders over the next 3 months. But quite frankly, it may take another month for this, because last year it was almost like clockwork. August 15th is when the market started up, made that 2.5-month run.
You brought up central banks, and you're right. I mean, they continue to be net purchasers of gold. That was true in May. That was true again in June. That's been going on now, for, as you mentioned, for years. They continue to buy gold. And for those of you who are new listening to the podcast today, wondering why central banks buy gold, well, they do it for a variety of reasons. They do it for emergency reserves, for crisis prevention. They do it to provide instant liquidity to their markets. They do it to reduce a country's balance sheet risk, because unlike other assets, physical gold is a real asset that carries no default risk because it's nobody's liability. So in many ways, gold does provide that wonderful contingency against unforeseen events. And that's why we own gold here at Follow the Money. That's why I believe that in the future we're going to see prices much, much higher than we see today. Tom, you know, speaking of central banks, though, we've also been seeing them ramp up their exposure to higher yielding and riskier assets like mortgage-backed securities, emerging market debt. We have total world debt now standing at somewhere around $247 trillion. I mean, you would think in this environment, you would not expect this kind of complacency to be setting in, especially after we had the jarring 2008 crash. It's going to happen again, Tom. And you can feel the buildup right now, even though gold prices are going down. What does it look like as you look out at global demand, not just central banks, but what about China? What about India? Are they seeing their demand improve right now?
Well, they are, Jerry, but there's that elephant in the room with the tariffs and the trade stuff going on. We just got reports of China, both imports and exports, decreased, and we're seeing things really tighten up in the world economy. Just thinking 2 or 3 weeks, we're already seeing the Fed now questioning whether they're going to raise rates, and that was just over the tariff deal with China. So it could be sooner than later, and certainly when we were expecting 2 more rate hikes this year, according to the Fed, according to Fisher, we now look like we may not have any or could have 1 more. But people out there now, major writers are talking about recessions. It just is unbelievable how things go back and forth like that. And you just look at it and see how fickle people are, because the one thing you and I agreed on the first day we sat down 7, 8 years ago and talked is asset allocation. You've got to divide and be in some different areas. You can't put all your eggs in stocks or bonds. And I promise you, there can be so many people killed this time that said 10 years ago, I'll never do that again. And I play golf with some guys, and every one of them now all back in the market, 100%. They were telling me 10 years ago they would not ever, go back in the market over 50, 60%. But that's the way it is. I talk to people and do conference calls all the time. They think happy days are here just because of Trump's announcement that they were cutting taxes. They just translated that. But one other sentence on that, look at the deficit, Jerry. I mean, my gosh, we're making Obama look like a choir boy. I mean, Trump's deficits are just running completely out of control. And our tax revenues are not coming in, and it's just a scary thing when you look at all the possibilities, and you can make a case that, wow, it's all going to settle down, and stock's going to go way up, and they're going to quit raising rates, and gold's going to shoot back up. And it's just like that's the reason it's so important that clients spread their risk across different asset classes.
So true. I mean, money has those eroding factors, one of them being inflation, unfortunately, in this current environment we live in where we have fake paper money. It's just basically debt-based. Therefore, inflation is a constant drag upon the purchasing power. And we see right now the latest CPI figures, which show the official government numbers, at around a 6-year high, which is quite significant. The Fed was trying to stoke this inflation, at least on an official basis, and it seems that it's beginning to pick up and accelerate. And the U.S. dollar, of course, has also been steadily rising in response to the rising interest rates. That's been hampering gold too, hasn't it, Tom? We really haven't talked about the dollar, but the dollar, its near-term strength in this environment
no question.
Is also.
The dollar, after getting killed last year, I mean, just think last year in 2017, it lost double digits to the euro and 8 or 9% the British pound and 6 or 7% to the Swiss franc, and this year they're up about 4% halfway through the year. So you're exactly right. That's definitely hurt thing. But if you look at, you can go to a website and look at gold and other currencies. Gold's up in every currency in the world except the dollar this year, and last year it was almost the exact opposite. I mean, the other countries were up more. The U.S. was up more than they were last year because our dollar was crashing down. Now it's just the opposite. All the other countries are now making money in gold because their currency is weaker against the dollar.
You know, one of the questions we get here, Tom, quite a bit regarding gold prices has to do with what you had brought about a while ago about the Fed raising interest rates. I mean, the Fed has certainly began its hikes of interest rate targets. And as interest rates rise, some other investment assets become more attractive as their yields rise, and money tends to flow to the rate of highest return. We know that. And since gold is a non-yielding asset, as it pays no interest to the bearer, I know you've addressed this before, but I think it bears repeating again, especially in this current environment. How do you expect gold to fare if the Fed stays on its current path of interest rate hikes? How does higher interest rates not harm gold demand?
Well, as I've done back a few months ago, I had that question from one of your listeners, and I sent it, and I don't have it here. I thought I had it. Oh, here it is. I actually have it here on my desk because I had to pull it out. Let's go back to June 30th, 2003. The Fed rate was 1%. Gold was 3.46. 1 year later, on June 30th, Fed raised rates to 1.25%. And gold went to $3.96, up $50. The next year, to June 30th, 2005, was when they had their two big rates and went all the way to 3.25% from 1.25. Gold jumped to $4.37 with a 2% rise in the federal rate. 2006, they raised it another 2% to 5.25. Gold was at 6.14. And then a year later, when they raised it to 5.5. That's when hell broke loose, June 30th, 07, and gold still went on up to 6.51. In every one of these periods, the federal rate, when it's got into a long rise in interest rates like we've started now, gold wins, and it's won every year. The last 2 years, gold has averaged over 12% a year. Now, certainly this year is not doing that. It's down by about 4 or 5%. But historically, when the Fed rates are rising, the gold market does well. It does well. I know it's hard to believe, but it does well.
Before we transition into silver, because I want to get your take on silver as well, just one more thing about gold, and I think many people may not realize this. But we often think of silver being the technology component. But in gold, we're seeing that technology is playing an increasingly important role in demand. I just recently read a report that said that, quote, over the past decade, the technology sector has accounted for more than 380 tons of gold demand annually, a significant figure in itself and almost 13% ahead of central bank net purchases during the same period. So as we see this, the growth in the global economy, and as we see technology continuing to grow, gold is a component within many of these electronic devices that we may not think about. And, of course, that's creating demand as well. And so if we have more explosion in technological demand, technological advances, they also rely upon not just silver but also gold.
Well, we're hearing gold actually in 2017 had more sales in that sector than they did in the investor sector. It's always been that way in silver, Jerry, for past 2 decades.
Right.
In gold, it hasn't been that way. And there is one trick thing in there that just to let your listeners know, a lot of people do, they call jewelry, which a lot of it goes, especially in India, they call it commercial use. They don't call it investment use, even though you and I know they're buying it for adornment, for dowries, but they're actually buying it, to protect their assets and do that. So the classification there makes that question a little tricky because it's hard to say all the gold going to India is, for commercial use, when even though it may be made into solid jewelry, it's really there to melt down in case of an emergency through all the different tax ramifications. But the one thing we do know for sure that you've already said is the demand for gold in the commercial sector is poised to make much bigger rises in price than it ever has. So that is very important as we go forward.
One technical note on gold for our listeners before we move into silver is the current price of gold right now is sitting at around $1,240 as we do this interview. And right now, that's a very interesting place technically because that is the same area of support that we found back in December, in mid-December of 2017. The price of gold fell down to about $1,238. It found support there, and then it rallied well up to about the $1,370 area before it then came back down to the same area. So we just told some of our members here at Follow the Money, Tom, that now may be a very wise time to consider either longer-term options on gold or buying physical gold or getting some exposure to gold because it is right now sitting right above that support area, which makes it a fairly high-reward, potentially low-risk setup right now. So technically, gold looks interesting on the charts.
I agree. Got 1236 on our chart, and as long as it holds there, exactly what you said, we think it'll be back to 1350 plus by the end of the year.
Yeah, this could really be an ideal time with all of with nobody really paying attention to gold, and the more gold becomes hated as an investment asset, the more we like it. Of course, it becomes more attractive. Okay, so let's switch gears to silver because silver is also one that many people are very excited about, but just as we mentioned, it's becoming more hated now because people have lost the enthusiasm because silver has been dropping in price. It has certainly been discouraging to watch it on the chart. If you're a technical trader, you can certainly see that silver has been stuck in a range, almost a very annoying range for some time. And just over the last couple probably over the last few weeks, Tom, we've seen silver lose that $16 support. And now it's moving back down to that $15.50 support. What's going on in silver? Is it being affected by all of the same factors as gold? Give us an update on silver.
Well, it's a little bit different. There's much more when you hear the people like J.P. Morgan shorting the market. It has a much bigger effect because of the size of the silver market is so much smaller than the gold market. So part of it, is manipulation. I mean, the silver doesn't go anywhere. The cost of mining, it runs from about $15 to about $16.50 worldwide. So how long can they make commitment, to mining and expanding mines and buying new machinery to do that, and it's just not going to happen. But the most important thing, the technical thing in silver is exactly what you said in gold, except we're experiencing, as I talk right this now, with silver sitting at 1580, Jerry, this could be the fifth bottom at 1580. If silver will hold this week at 1580, this will be the fifth time in 17 or 18 months that silver's gone to 1580. And every time it held, and every time it went back over 17, just like we've been talking about with the gold. So we're seeing, just the end of last week and the start of this week, we've seen more of our big investors have bought gold and come back in, but are just starting to buy silver because they just say there's not an investment in the world that has more potential and less risk than silver. But what we don't know is the volatility and how much longer. But I mentioned to you earlier today when we talked that we've got some very significant people in Asia that are saying that the rumor over there, and it's probably even more than a rumor, I mean, not as much a rumor, it's got a lot of truth to it, is these bullion banks are going to quit shorting silver sometime soon. And you got to remember, from 2000 to 2011, silver went from $3 to $48, 16 times in 11 years. And now we're sitting there, say 16, and what if it only went back to 45, 48, it'd be a triple. But I think it's going to be more than that because they're going to get in the long side of this market sometime in the near future. And when they do, all of our listeners and people that got discouraged because the price wouldn't do anything. And then we'll talk about the Krugerrand in a minute. But what I'm telling everybody out there, Jerry, is they need to be buying silver. It's a low-risk, high-reward investment that does have a question mark as to when that'll happen, but it can change overnight. If all the shorts went off of silver, and even if these major bullion banks didn't go long, if they just went neutral, silver would start rising right away.
Before we conclude, because I do want to hear some of your specials that you have right now, some of the different coins and bars that you have available for people who want to call and inquire about that, I have noticed generally, I mean, here we are at Follow the Money, we're tracking trends. We've been tracking trends for a long time, and one of the things that we're beginning to sense from the charts and from our research is just a general complacency, and we don't just see it, of course, in the market. We don't just see it in the price of the volatility index. We're also seeing it in the personal savings rate of the United States, which has come down to an area that we haven't seen since the 2008 crash. So we're noticing here, and it surely has to be something to do with the Trump effect. President Trump has certainly created a sense that the economy now is moving higher, even though it's being fueled, as you pointed out, completely by debt. No one is really pointing at that. And Tom, as you brought up Obama, back whenever President Obama was in office, it was not uncommon to hear about our national debt. It was not uncommon to hear about the deficits. But today, now with President Trump in office, it's almost like those voices have gone silent, and nothing has changed fundamentally. The complacency is creeping higher. It almost seems like we're heading right towards a perfect storm here.
I agree. I'll tell you what, I agree. I had a client this morning put in over $500,000 into silver, which is about 5 or 6% of his assets. But he analyzed everything over the weekend. He looked at every market. He says definitely the lowest risk market. And he's very well astute on looking at charts and following trends. But that's the kind of thing we're seeing. The big guys are coming in, the little guy still scared to death. But I think the evidence of what the South African is, we just announced today that we have been accepted as one of the sellers of the new silver Krugerrand. The Krugerrand is probably the most popular gold coin in history because it started in 1976. And now here we are in 2018, and they finally have got enough silver to make a silver coin. And we're sending that out, right away, and people that aren't on our mailing list can certainly find out on FTM Daily how to get on there. We don't share anybody's email. It's completely confidential. But we're excited to see another country step up. Now we have Australia, Mexico, United States, England, Canada, and South Africa and Austria. I think it's 7 of them that have, the sovereign coins made by and backed by a country. So, and I think the Rand Mint is probably the top mint in the world, most people would say. So to see them making this kind of commitment to be in the silver business tells you a lot. And they'll be buying a lot of silver and taking it off the market as they make it into coins. But those are available as of today.
Friends, if you're not on Tom's email distribution list, he puts out news occasionally, and he also puts out price specials. So those of you who are gold and silver buyers and you want to know, when the deals are happening, if you want the sales sheet, if you will, you can go to followthemoney.com/gold and just type in your first name or your last name and then your email address. And that'll be sent right over to Tom. Of course, it's a very private list. We don't share it with anyone but Tom. And Tom, you don't share it with anybody else either. So it's a very private list. Before we run, Tom, do you have any specials you want to share with our listeners today? What's going on right now?
The silver Philharmonics, the silver Philharmonics are about $1 below their normal price, which is unheard of. So we're selling a lot of silver Philharmonics, but we only had 30,000 to sell. We're about 2/3 finished. You can buy them as little as 20 to a roll. It's, $300-something. You don't have to do but that. And then junk silver, we've just got quite a few bags that we're selling at an astounding rate of I think it's 60 cents over spot. Full bag has 715 ounces of silver, but you can buy a half bag or a quarter bag or the 10th bag at the same rate. You don't have to pay that. And then we've got some Austrian Coronas in the gold side that are only they're 2.95% over spot. And gold eagles that are normally 5.75%, we have at 3.95% over spot, and that includes the shipping and the insurance. And then, but that's prime. And the biggie is the French 20 franc for those that want coins that are foreign gold coins and fractional gold, good for bartering. It was a legal tender coin that was made from 1856 to 1914, and it's a 1/5 ounce gold coin. Some of them have Napoleon on them. Some of them have the rooster on them for several years. But they're usually 6.5% over spot. We've got those at 3.25% premium. I've never had that since I've been in business. So some exciting things there. And then the last thing from my end, Jerry, and I'll let you ask me the last question, but keep an eye on platinum. I gave this show a buy signal 3 years ago, and it went up 50% over a 30-month period. And I'm very close to doing it again. And remember, platinum is really into some strange uses commercially that are coming on that could absorb a lot of the platinum. Platinum is about 45 times more rare than gold. You buy platinum in 1 ounce platinum bars or platinum maple leaves or Isle of Man nobles. They also make palladium coins. But right now we're very close. We've already had some investors that are entering the platinum market early. Platinum is a little higher premium than gold just because of the way it is to make it and so forth and so on, the different melting points. But it still looks like a great investment for the next decade, but I haven't given a buy signal in it yet.
Platinum currently, as we do this interview, is currently trading at about $830 per ounce, and in fact, it's eerily similar, Tom, to the both to the silver and almost to the gold chart, where we see the price of platinum now pulling back to just above $800, which is a really important support level. That was the low we hit back in early 2016 before it blasted off and gave us it was a really nice return but went up to about $1,200 from about $800. So we're right back down to that same support level on platinum. So the metals are looking very interesting technically, and it sounds like the fundamentals are also looking up.
They are, Jerry. They really are, and just people need to do their homework next month, because I really feel, and everything I'm hearing from our sources is saying around August 15th is when they expect. I can't tell you exactly what they're counting on, but I'm talking to different people. Some of them don't even know each other that are telling me the same thing. But last year they were right. That's when we had the big move up, like we talked about earlier, was in that August 15th to Turkey Day, Thanksgiving, and then we saw a drop at the end of the year as some people sold off to take losses or gains or whatever they were doing for tax reasons. But that happens every year.
Friends, we're living in the largest debt bubble in world history. We have never seen this amount of debt around the world. Our money is debt-based. The total world debt stands nearly $250 trillion, and there is no plan. There is no plan to pay off this debt. There is no plan to save the pensions. There is no plan to save Social Security. There is no plan to save Medicare. It's all on you. And one of the smartest things that you can do, as Tom pointed out at the very beginning of this interview, is to diversify, is to make sure that you don't have all of your money in a 401k or all of your money locked up in your primary home or all of your money locked up into the U.S. stock market. Instead, it's very wise to have your money spread out. And one area that you can do that, and also a very powerful way, is to have some physical gold that you can share, that you can hold in your hand. I love, Tom, to break out my silver and my gold coins and bars with my sons and talk to them about gold and let them hold real money in their hand. Most people have never held real money in their hand, and that's exactly what gold and silver is. If people listening to this broadcast want to diversify, if they want to contact you, tell them how they can do it and tell them what that process looks like.
Well, if you just you can call us at 800-247-2812, and we've had a great track record with clients that heard us on FTM. So when you're ready to order, you can order right then. We'll lock you in. You got to realize if it goes down tomorrow, you can't, say I don't want to order anymore. But we have that problem so few times last 10 years because people we deal with are high integrity people as we are. So anyway, you lock it in. We email you an invoice. You send us a check. 2 days later, we send you the gold and silver, and we pay all of Jerry's listeners all the postage and insurance. So that's on top of our low prices. We give you that. And Dan Scoggins in my office has been with me 24 years, I think, and he can help you. And Kathleen can also answer questions. So, and I'm in a lot, traveling a little bit more than I'd like to, but I'm around and can always call you back. So once again, just give us a call at 800-247-2812, and if you don't have a self-directed precious metals IRA, we can function as your broker and help you decide what percentage in each metal and show you how to get a custodian. So we're happy to do that.
Tom, it's always an honor to have you on the broadcast. Thank you for your time today, and I look forward to your future updates.
All right, Jerry. Thank you. It's great being with you.
God bless you, my friend. All right, friends. Well, that brings us to the end of our program. Thank you so much for choosing to allow us into your life each and every week right here on this broadcast. And as always, I like to leave you with a final word, this time about gold, our topic of the day, actually taken from the book of Proverbs, chapter 8, which focuses upon the blessings of wisdom. And in the 19th verse of chapter 8, Proverbs, it reads that the fruit of wisdom is better than gold, even fine gold, and its yield is more than choice silver. You know, that's a very interesting statement, because the truth of the matter is that you and I cannot take our gold and silver with us when we perish, when we die, when we pass. We can't take it with us. And the Bible tells us that gold and silver are good, but they're not as good as wisdom. In all things we should seek wisdom, and not just any kind of wisdom, but godly wisdom, which is found in God's Word. And that's just something to think about. Remember, friends, when you want the truth, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
The information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.